Hello friends, good afternoon and a very warm welcome to all of you to another webinar session of GST. Today's topic is supply and its valuation. Today we have Deepak Naik sir with us all the way from Pune. He has an experience in indirect taxes for around 25 hours and he's worked in the Central Excise Customs and Service Tax Department for more than 16 years. He has also worked with Volkswagen and KPMG indirect taxes in Pune, and he has been involved in the GST impact analysis and is a member of the GST core group committee of ICSI. Currently, sir is freelancing and is also a director in Taxon Solutions Private Limited, and he provides his services in indirect taxes and related areas. Sir has also been a member of Indirect Tax Committee of Maratha Chamber of Commerce, Industry and Agriculture. Today, sir will take us through the provisions of supply and its valuation. Over to you, sir.
Thank you, Nikita, for a nice introduction. Let us begin with today's topic, and this is mainly relating to valuation. But just we'll have a small understanding about GST, how it is knocking, means the clock relating to GST is already begun. So now today we are on 13th April and 78 days are there. If we think, or if the GST will get rolled out by 1st July 2017, so almost 4 GST central laws, so central GST, CGST, IGST bill, Union Territory GST bill and GST compensation cess, so cleared by upper and lower house of the parliament, so will soon become act. So GST is reality. Now we should not think that just to wait, GST is coming. Now GST, there is a certainty GST is coming within next 78 days. So how we are prepared to face GST? So really just I will give you one small example. 3 days back I was with one forum for on a GST seminar, and at that point of time I was just discussing how industry is prepared to face GST, to what extent industry is preparing for the GST. Now many of the participants just explained that yes, we are ready. So it was very big surprise for me. I just requested them, please explain what sort of preparation or how you are saying that we are ready with the GST. In that case they explained that they have obtained this provisional registration number under the GST. Now just it was a very big alarming call for me that many of the industrialist people, they are thinking that getting a provisional registration is almost everything done to face GST. Then I would say it is not even 1% if we want to complete 100 steps for GST. So this is just a beginning. Now when we talk about the GST, there are a lot of aspects and lot of chapters, lot of concepts. So filing of return, getting registration, payment, so lot of things are there, as well as various GST concepts one has to understand when the intrastate transaction is there and which type of GST is payable, when it is a interstate transaction, place of supply of goods and services, audit, lot of things, investigation, demand provisions. So out of this, valuation is one of the most important part. So today we will discuss what are the provisions in the GST bill, central GST bill. Almost it is applicable to similar provisions are there even in the state GST bill as well. So and IGST bill as well. So these valuation provisions would be very crucial to understand. So we will try to understand some of the basics relating to these valuation rules. But before we directly enter into valuation rule, first we will understand basics about the GST, where the valuation is almost important, or to understand valuation we have to take other provisions into account as well. What are those? The basic of GST is charge. from where the charge of GST is created. Now the charge of GST, whichever GST we are talking, CGST, IGST or SGST. So the charge is basically created on intrastate or interstate supply of goods or services. So it is charge on supply, but this will not apply, this charge will not apply to sale of alcohol or alcoholic liquor for human consumption. But the most important thing I would like to bring to your notice, that this charge is on value determined under section 15. So this is one of the most important aspect in a charge, because in a today's situation, when we talk about central excise duty, this is charge on manufacture. So, and when we talk about service tax, this is more or less a similar situation, that is, it is in case of service tax, it is a charge on provision of service, and at the same time it is charge on value of provision of service. Similarly, in case of GST as well, more or less similar provision is introduced here, that it is a charge on value, and that value of supply of goods or services or both is determined under section 15. So that is the basic provision of charging section. Likewise, when we talk about supply, one can understand meaning, what is the meaning of supply. So in that case, even we are not going to read a technical definition, but some of major ingredients of supply, whether it is for goods or service, we can discuss about that. So we will understand that all forms of supply of goods and services are covered, but that is for a consideration by a person in a course of furtherance of business. So that consideration has to be there for any supply to get charged under GST. At the same time, when we talk about import of service, again those import of service should be for consideration, whether or not in the course of furtherance of business. And then there would be one question, that there are certain situations where even charge of GST is created, or supply includes certain transactions which are covered or mentioned in schedule 1, and that is supply without consideration. Even GST would be applicable, but in a true sense, if we see holistically, this is in fact a transaction which is for a consideration on a holistic basis. If we see only a first leg of transaction, one may say that there is no consideration. For example, a branch transfer. So person transferring goods from one location to another branch or depot located in another state. So GST would be still applicable on such transactions. Now ultimately that branch or depot is going to sell or supply those goods from the depot location. So certainly there would be a consideration thereafter. So wherever we are talking about a GST, the most important thing we have to understand that this charge is on supply of goods and services, and that is also, this is a charge on the value. So that is the most important thing, and that is why one has to understand what is the meaning, what is expected to a lawmaker, that what should be the value on which the GST is payable. So simultaneously we are talking about a consideration. So before starting or before we commence with the understanding of section 15 about valuation, one more understanding about consideration is also equally important, that one has to understand what is the consideration, because GST is chargeable on supply for consideration. Now what is the consideration? Consideration is any payment made, whether in money or otherwise. So there should be payment. This payment made by recipient or any other person, it is again immaterial. Payment has to be there. And then the monetary value of any barter or exchange. So the recipient may agree to do certain act, so or may agree to provide any service against that supply, or may agree to supply any goods. So Such transactions, barter exchange, would also attract GST because monetary value of such transactions have to be arrived at. So this is also one of the important change which one has to understand, because in such case there would be a real challenge to ascertain the value, and we have to take lot of provisions in this connection. So then even as per the provisions, subsidy given by central or state government is not includable in a consideration. And one important provision in this connection is the deposit. So if the deposit is given, that shall not be included as in the consideration unless and until the supplier applies such deposit as a consideration. So till that time it will not be considered as a consideration. So considering all this entire background, we should understand what is there in the minds of lawmaker, that what will be the value or on which the GST is payable. Now a section 15 of CGST Act, more or less the same section, same provisions would be there in the SGST Act. All 31 states in India would obviously have to pass SGST Act in the respective state assemblies. So provisions would be similar. So even for IGST Act, Integrated GST Act, no independent provisions are there for the valuation, and these provisions of valuation of CGST Act under section 15 are applicable. So almost wherever we are discussing, the basis of valuation for our discussion is the provisions under section 15 of CGST Act. So at the same time, this is, we have already understood that this section 15 almost is the basis or common for CGST, SGST, IGST and Union Territory GST. This section is also common for goods, supply of goods and services. There is no differentiation, because there are certain provisions, point of time or place of supply, these are different. For supply of goods are different and for supply of services are different. But when we talk about a valuation, there is no such differentiation. The basic section 15 is common for ascertaining value of goods or service. So for both it is the same. Now the basic provision of valuation, which is contained in subsection 1 of section 15. So what is that? The value of supply of goods and services shall ordinarily be the transaction value. So across globe in indirect tax, transaction value is the basis. Now almost since a decade or even long, most of the indirect taxes, we have central excise law, service tax law, we have already shifted. Currently also we are working in a transaction value regime. So since indirect taxes, whatever we are discussing, current regime and GST, this would be, or this is a transaction tax. So for each and every transaction, a transaction value has to be understood, and the GST is payable on the transaction value. So this transaction value is the price actually paid or payable for the supply of goods and services, actually paid or payable for that transaction. So we may have a enormous transaction, month 1 we may have a supply of goods, month 2, month 3. So almost we can have a separate or multiple transaction values for different periods. So it's not that in the month 1 we are selling or supplying goods, say for 100, then throughout the year or 2 years, 3 years down the line, the value should be the same. Is not the case. And even on the basis of volumes from the customer to customer, this transaction value may be different. But what is the essence is, this is the price actually paid or payable for the supply of goods and services. So actually paid or payable is the most important. And when we talk about a transaction value, obviously we have to take into account two important provisions or two important conditions. so that the transaction value is acceptable. What are those two conditions? First condition is supplier and recipient are not related persons. We will understand the meaning of related persons separately, but for a current discussion at this moment, firstly we have to understand that the supplier and the recipient should not be related persons, so that the transaction value declared on the tax invoice can be accepted. Now, what is another? There is another condition. What is that? Price is the sole consideration for the supply. This is also one of the condition. Sole consideration. So long as there are multiple considerations, consideration in money or in goods, everything has to be clubbed. So any additional consideration at the point of supply or post supply, if there is a link, whatever activity, transaction or payment even happening post supply is received by the supplier having connection or for the reason of the supply, has to be considered as additional consideration. And since the invoice value is not then for a sole consideration, such additional consideration has to be added into that. So to sum up, what is the transaction value? Transaction value is the price actually paid or payable for that particular supply of goods and services, and that price is accepted as a transaction value only when the supplier and recipient are not related and the price is the sole consideration. Now, concept of related person is not new for central excise customs law, but may be new or would be relevant to understand for those who are exclusively working or exclusively engaged in providing services or only engaged in a trading activity where only they are doing compliances under respective VAT laws. So such type of concepts are almost not there, but those who are complying with central excise law, there is a concept of related person. At the same time, even under customs law, there is a concept of related person. Now, customs law or duty of custom is not part of GST, but the concept of related person under customs law and central excise law is defined in a separate terms, is not a perimetria. There are certain differences. At some point of time, there is a similarity, but some points there is a difference. Now, when we talk about a concept of related person under GST, it is more or less similar to concept of related person under customs law. It is not just copied and pasted in a GST law from excise law, but rather it is taken from the customs law. So, we will see some important provisions relating to that, how the parties are treated as a related person. Why this is important? Because the price charge, the value charge by a supplier to recipient can be accepted only if they are not related. So, we have to understand here how this relation is established or what is expected in the law to hold two persons as a related person. So, these terms are defined that such persons are officers or directors of one another's business, and such persons are legally recognized partners in the business. So, joint venture even covered because of that. Such persons are employer and employees. So, this is one very important thing we have to understand here, because any facility provided by employer to employee is also under GST net, and that too, one important thing, there is a general practice to provide such facilities at a concessional rate or provide perquisites to employees is a common practice. Now, because of this clause, even certain facilities, for example, a car facility or transportation facility or a canteen facility extended by employer to employee at a concessional rate may attract GST even on the perquisite. So that is very important aspect. One has to really understand to what extent GST is applicable on such transactions, because these concepts are very new as of now, and currently under service tax law, under VAT law, we are not practicing such type of transactions. So here it would be very important to understand the implications of these transactions. Even any person directly, indirectly owns, control or holds 25% or more of outstanding voting stock or shares, both of them. So like a parent company need not be always a holding company, because 25% shareholding we are talking here, so is not about 51%. So even a third person or a parent company or any other company need not be a holding company, but holding 25% or more of voting powers will also become a related person. Even one of them directly or indirectly are controlling others will also become related person. Both of them are directly or indirectly controlled by a third person will also be a related party. And then together they directly indirectly control a third person, or they are member of the same family. So the concept of related person is very vast under GST law, and really one has to understand implication on various transactions, and really in a supply chain one has to ascertain whether they are making supply of goods and services to a related person or otherwise. If really one is making supply to related person, then the price charged in the invoice is not straightway acceptable, because it is not covered, it is excluded from a transaction value. The value declared on the invoice for such persons, for supply to such persons, will not be accepted straightway, and we have to make certain additions, deletions, or we have to understand what will be the valuation base in a different situations. We are going to discuss about that as well. So here the term person also includes a legal person. It's not always a natural living person, but artificial persons are also covered here obviously. And then a person who are associated in the business of one another. In one is termed as sole agent, sole distributor, sole concessionary, shall also be deemed as related. So the entire magnitude of concept of related person is very vast, and one has to really understand how the concept of related person is impacting their business activity. So now we have understood what is a transaction value, and in the normal course the transaction value will form basis for the GST. Now there are two rules, 15(2), subrule 2 and subrule 3 have to be also taken into account. So subrule 2 of section 15 prescribes certain situations, and these are the includables. So by default, without any interpretation, one has to see that these points or these elements have to be added in the transaction value. These are includables. What are these? Taxes other than GST. We will see in detail as well. So taxes other than GST, amounts paid by recipient on behalf of supplier, incidental expenses charged, interest or late fees for delayed payment, and then subsidies other than those provided by the government. So we will see one by one what is the implication and what are the provisions relating to that. So the first clause, any taxes, duties, cess, fees, charges levied under any other statute other than CGST, SGST, IGST, UTGST and GST Compensation Cess Act, if charged separately by the supplier to the recipient in the invoice, would have to be added. So is almost like a cascading effect which is there in a current regime, where for example when somebody is selling manufactured goods, who is a manufacturer, he is discharging excise duty, so excise duty has to be added in the transaction, in the value, basic value, and then the gross value forms the basis for VAT. So it is more or less such situation is there. Now, but the most important thing, most of the indirect tax which are going to subsume in GST will lose their life. So there would be very few situations that the suppliers are still required to pay any such indirect tax other than the GST, because majority of these act, that is excise, additional duties of excise, different types of cess, service tax, VAT, these would lose their life, and then the everything will get replaced, most of these subsuming tax will get replaced by GST, then what will left? So yes, there are few taxes I would say. For example, tobacco products are under dual taxation. So there would be a GST, at the same time there would be a excise duty leviable on tobacco products. So altogether excise, Central Excise Act will not lose its life, because it will have limited application, maybe for tobacco products or petroleum products. But anyway, this situation may not be there for petroleum products, because there is time being no GST on petroleum products. So we can explain or give example one of the case that excise duty on tobacco products, if payable, because provision is there, then obviously that excise duty will have to be added in a basic value, supply value, and then the GST will be payable on the gross value. So it's like a cascading effect there, but such type of situations would be very less, and it's not a common situation at all. Then another provision, that any amount that supplier is liable to pay in relation to supply, but which has been incurred by the recipient and not included in the price. There could be an arrangement that instead of any expenditure incurred by supplier and charged as a price to the recipient, they may have an agreement where the recipient is directly paying to that supplier or vendor instead of being paid by supplier first. So this situation is covered here. So in that situation, if the recipient will make any payment directly to the third party, that payment will be added into the value, and then GST is payable on this gross amount. So if there is a free supply of inputs or services, that is a different thing, will have to be considered for GST under separate provisions, but not under this provision, because in this provision we are talking about amount paid. So long as there is a payment in money by the recipient, this provision is not attracted. And then is not a just payment by the recipient. Important thing is that the contractual liability or legal liability for making that payment is on the supplier and not on the recipient. Is a mere arrangement that recipient is paying, but the legal liability is on the head of supplier, then only this provision will get triggered. For example, if the supplier who is the manufacturer and he is doing advertisement for his products which he is manufacturing, and he has engaged some advertising agency, and then his dealers, they are making directly those payments rather than making payment by suppliers. In that situation, this provision may get triggered. This is one of the example, but there could be other examples as well, where ideally or legally or a contractual liability is on the supplier, and instead the payment is made by the supplier. The arrangement is the recipient is directly paying, and to that extent such amounts would get added to the transaction value or to the value of supply, and on the gross value GST is required to be paid. Now, a third provision thereafter, that is proviso subsection C here. So, certain incidental expenses charged by supplier including commission and packing, and any amount charged for anything done by supplier in respect of supply of goods or services at the time of or before the delivery of the goods, all these transactions expenditures which are charged and recovered, GST would get attracted. So, example of such elements or such things are packing charges, forwarding charges, loading charges, inspection, testing charges. So, there is a practice, say for example, price of supply of goods is 100, and then the supplier is saying I am doing some additional packing or something which is as per your requirement, and I am charging 10 rupees as an extra, or he will do inspection and recover inspection with the third party and recover those charges. So, this such type of charges are treated here as incidental expenses, and which are charged because initially incurred by supplier and recovered from the recipient. So, all such incidental expenses would form part of the transaction value. These are includable. So, very recently, not we will say 2 years back, there is one decision of Honorable Delhi High Court, and is in case of Intercontinental, and particularly such incidental expenses whether to be included in the value of service, provision of service, gross value of provision of service or otherwise. So, if I will give you example, the High Court of Delhi has given a verdict that this is not liable to service tax, considering whatever the legal provision was there at that point of time. Thereafter, obviously on 15th May 2015, government has amended the provisions of section 67 relating to valuation, but now they have taken care in drafting this law, all such incidental expenses. If I am a professional and my fees for delivering a particular service or any opinion is 100 rupees, and I am charging incidental expenses for travelling, lodging, boarding, something, say for example 10, and 100 is also recovered as a fee and 10 is also recovered, so 110. So, this such, even there is a no markup and expenditure at actual, if it is incurred and recovered, will be treated as incidental expenditure and which is charged or recovered from the recipient, and thereby GST will get attracted on these transactions. Then there is one another new concept, or government is very creative on this part. So, interest, this is not a interest per se, that is not a finance cost as such we are talking. So, unfortunately, as a clear cut, there is no mention of interest under negative list of GST, that is a different part altogether, but what we believe that there will be soon clarity or some exemption given on the interest as well, but here we are talking about altogether different thing, where interest, late fee or penalty which is charged for delayed payment of any consideration for supply. So, this is a normal phenomena where as a practice seller, supplier generally mentions by default on their invoices that 9% interest will be charged if the payment is made, say after 60 days, 10% interest will be charged, whatever, depending upon commercial understanding. In such cases, currently central excise duty or service tax is not liable because the specifically legal provisions are such in the respective acts that such duties or service tax is not attracted even if such interest or penalty is charged for delayed payment. But now in case of GST, lawmakers have specifically included this portion or this element that whosoever the supplier, if charges interest, late fee or penalty for delayed payment, GST would get attracted. So, one more includable in a transaction value is subsidy directly linked to the price, excluding subsidies provided by central and state government. So, subsidy shall be included in the value of supply of supplier who receives the subsidy. So, there are different types of subsidies. It's not necessary always that the central and state governments are giving subsidies. Again, last 2-3 years, because of one of the decision of Honorable Supreme Court in case of super Cenotex, lot of issues under central excise law were created, and various state governments, they are giving package scheme of incentives or subsidies to those manufacturers who are setting shops in their respective states, and they are getting subsidies, and because of the decision given, verdict given by the Supreme Court, department initiated inquiries, investigations against those manufacturers who were getting subsidies from the state governments. But now the most important thing here, any subsidy to qualify as a includable in a transaction value, the first important thing is that subsidy should be directly linked to the supply. That is the first condition, and subsidies given by central and state government are not includable. So, generally subsidies are given by government. Yes, in commercial transaction, private parties, even the recipients are also giving subsidies to suppliers for various reasons. That is also a practice, but not common. Generally, when we say subsidy, people or in general understanding that subsidy by the government. But here one important point I would like to make, that subsidies if given by local authorities or local government, law is silent on that, because what is specifically excluded is subsidy given by central and state government. Now local authorities or local government is defined separately. So whether that can be termed as state government or not is again a question of interpretation, but there could be chances of disputes if the subsidies are given by local authorities, whether includable or not is would become a issue unless resolved or clarity is made on this point. So recipient, whether whenever paying any kind of subsidy to the supplier, will get for early delivery, maybe a transportation subsidy or lot of types of subsidies are given, and those would be added so long as it is not given by central and state government. Now we have discussed about what is includable. At the same time, there are provisions about what shall not be included in a transaction value, and these provisions are particularly or specifically relating to discounts. So many a times there is a practice of giving discounts. Such discounts may be pre-delivery, at the time of supply, or post supply or post delivery as well. So first we will see the provision, what is provided or prescribed in the law, GST law, relating to discounts which are given prior or at the time of supply. So whenever such discounts are accounted or shown or claimed itself in the GST invoice, tax invoice, and value is reduced to that extent, GST is payable on reduced value. So, ideally such discounts are allowed because they are settled along with the transaction itself. Whereas there are post supply discounts as well. So, even the law allows that such discount need not be or should not be included or shall not be included in the value of supply, provided the conditions, certain conditions are there and these conditions are satisfied. What are those conditions? Such discount is established in terms of agreement entered into at the time or before the time of supply. So, such scheme of discount should be framed before the supply or at the point of supply. If it is the scheme, discount scheme is framed or communicated post supply, such discounts would not be allowed. Such discounts specifically linked to the relevant original tax invoice. It's not just gross amount of discount, but invoice wise tracking, original invoice wise tracking is required, and that transaction level compliance means a worksheet or entire working of the original invoices has to be either endorsed, attached, and then the discount is to be given, and then the pro rata GST attributable to the discount has to be reversed by the recipient. Obviously, because there is an input tax credit rule as well, since he is not making entire payment to that extent, the SENVAT credit is obviously not available or admissible to the recipient, but that is a compliance from the recipient end. But when we are talking about a discount, we have to see from the supplier's end, and from that perspective it is or it would be relevant for the supplier, since he is reducing his liability to the extent of discounts, he has to ensure or he should be ready with the proof that the recipient has reduced proportionate input tax credit. So, obviously he has to take or he has to see that such proofs are obtained from the recipient. So, again to sum up relating to discounts, in principle deduction on account of discount is allowed provided such discounts are actually passed on to the recipient. But most important thing here, that the scheme of discount should be known in advance, should be published as a normal practice of the business. It should not be something abnormal conditional discount. So, it should be a normal business practice. So, there is no specific percentage of discount that 20 is high, 25 is high, only 5 is permissible. This is not a case. The most important thing is the policy regarding discounts and conditions have to be published in advance before the supply. This should be made available to each and every customer who are getting supply, who are purchasing from the supplier. That is the most important thing. So, many a times this is in practice, these things or marketing people, they are following informally and no proper record is kept. So, at the time of assessments, if such discounts are disallowed, then it would be very difficult to prove such transactions, that how you have communicated the discount policy to your clients, to your customers. So, keeping that track, recording those email communications or price lists or whatever any other communication pattern is most important, because after all this will help at the time of audit, scrutiny, investigation. So, that is most important thing. And then obviously we have to track these discounts at a transaction level, where we have to collate these discounts with the original invoices, and we have to ensure or get a proof from our recipients that he has reversed the proportionate input tax credit attributable to such discounts. So, more or less similar practice is prevailing currently under excise law, even respective state VAT laws also allows, because such discounts are generally passed by way of credit notes, and the turnover, gross turnover will get reduced to the extent of such credit notes issued in that respective period. So, more or less this situation is followed in some of the states, but now it will be a uniform practice, and still there are some practical challenges as well. For example, cash discount. The concept of cash discount is generally, though it is termed as cash discount, it is not given directly in the invoice. The understanding of cash discount is that, say for example, if you make a payment in, say for example, invoice is for 100 and the scheme is if you make payment within 7 days, you will get a discount of 1%. Now, in practice, now what will happen under this situation, that my gross invoice, my invoice at the time of supply will be 100 and then GST will be paid entirely on 100, because really I do not know at the time of issue of invoice whether the recipient is going to make a payment within stipulated period, say 7 days, 10 days or 15 days, and then there would be a challenge for such type of discounts to be get settled thereafter, and GST benefit whether would be available. So, another way to treat this situation, that upfront pass a discount in the original transaction itself, but it is again a marketing strategy, and that is why whenever we are talking about GST, it is not just a tax change, it is a supply chain change. So, whosoever is a marketing team, what is their policy relating to discounts is also important, because giving discount in advance for a cash purpose and subsequently if the recipient is not making payment in a stipulated period, say 10 days, 15 days, then the whole purpose of discount will go away. So, again a debit note has to be issued, and again additional GST has to be charged in that case if such discounts are given in advance. So, really it is a marketing issue, it is a compliance issue, so it is a GST tax issue. So, we have to arrive at proper balance, understand this impact and requirement of compliance as well, and frame a policy depending upon our marketing strategy. So, that is equally important. So, this is relating, and then there are certain turnover discounts, or say after 3 months or 4 months, 6 months, if a particular sale is made by dealer, additional discounts are given by way of credit notes. Such discounts would be admissible provided the scheme is known in advance and the discounts are given by tracking original invoices, and the dealers who are claiming the credit has to reverse the proportionate ITC from their records. Now, what we have seen, that a transaction value is a basis for supply of goods and services on which GST will apply. So, basically this provision is covered under section 15(1). Now, there are, we have also seen 15 subsection 2 which are includables, and section 15(3) which is relating to discount and which shall not be added in a supply value or transaction value. So, the value declared generally in terms of 15(1) to 3, what we have discussed so far, shall be accepted as a transaction value, and there should not be any disputes as such. But now, in a following situation where consideration is either not wholly in money or partly in money, or parties are related and price is not the sole consideration, in such a situation there is a possibility, or the transaction value declared on the invoice shall not be accepted, and then the lawmakers have provided subsection 4, where in such situation reference to GST valuation rules is required to be made. So that is section 15 subsection 4, and then a subsection 5 is also important, where the respective government, they have given power to decide any other method of valuation. This is also important thing, because today we are thinking that MRP based valuation, which is mainly prevalent under excise law, that regime has gone. Prima facie, we also believe that MRP based valuation has no role in GST, because entire supply chain is captured under GST, and really on the value addition GST is applicable. So MRP based valuation is generally a one time levy, at one point levy. Now what is that role? As of now, we are not talking directly about MRP based levy, but since the government has power to notify any other method of valuation for payment of GST, but most important thing one can understand from this provision is that the production base or compounded levy schemes prevalent under excise law would not be justified now, because government will not have such power, because we have already seen that the charge of GST is on the supply, and that too on the value of supply. So basically the charge is on value, and then we have to follow entire supply provisions, supply for consideration, and all the relevant provisions so far we have discussed, and then this power is given under section 15(5). So 15 is for the valuation. So one can interpret from this that government may notify any other method of valuation, may be tariff values or may be a MRP based regime, but really that is a far-fetched, and one has to understand that government has power to notify any other method of valuation apart from what we have discussed so far. So this is about the entire valuation section which is contained in the act itself. But by taking power under section 15(4), particularly when the transaction value declared on the invoice is not acceptable because consideration is not in money, wholly in money, parties are related, price is not the sole consideration, for any such reasons the transaction value cannot be ascertained within the parameters, four corners of section 15 itself, because certain additions, deletions, comparisons have to be made, and that is why we have to enter into valuation rules, and that power is there with the government under section 15(4), that such provisions can be prescribed. Now till the end of November 16, one set of GST valuation rules was made available to the public. Now in the month of April, first week, or to be more precise on 2nd of April 2017, another set of GST valuation rules is made available to the public. Now this is a draft rule today. So for our next discussion during this presentation, the reference to the GST valuation rules which is made public on the 2nd of April will be taken for the discussion here during this presentation, not the earlier one which is published in the month of November or during the year 2016. So more or less the provisions were different, and now the provisions which are there are different. Now this is a draft rule. There is a possibility that these rules may get changed, because now the next GST Council meeting is proposed, I think on 17-18th May, where most of the major agenda is to recommend the classification, coverage of goods and services under different slab rates, that is 5, 12, 18, 28. So, these draft rules which are made available to public very recently in the first week of April, 4 draft rules are there. So, valuation rule is one of that, and it is expected that GST Council will discuss on these valuation rules as well and make their final recommendation as the draft as it is, or there would be some changes as discussed and finalized or decision taken in the GST Council meeting. So, what are those proposed rules or draft rules here? We will discuss those one by one as well. So, we have discussed so far about a transaction value under section 15, which is mentioned on the tax invoice and under certain parameters, under certain situations and conditions that is acceptable. Generally, it is a contract value or agreement value in a transaction which is reflected in the invoice, and GST is payable on such transaction value, and there should not be any dispute at all. But since certain conditions are not satisfied, which we have already discussed, due to those reasons the value is not acceptable, then different situations are considered in the valuation rules. What are those rules? The first rule under valuation is where the consideration is not wholly in money. So, for example, for a particular supply 50 rupees is charged in money and remaining part is not charged in money, but it is like a barter exchange. So, either the recipient has exchanged some goods or recipient has exchanged some services against that. So, the consideration is partly in money and partly not in money. So, how to deal with this situation? So, the sub rule, draft sub rule 1 takes care about this situation. What is that? The 4 points or 4 conditions, 4 aspects are given here. What is that? The value in this case shall be the open market value. We will discuss what is open, that concept is defined in the draft valuation rules. So, open market value has to be considered. Then if that is not there, then the sum total of consideration in money and money equivalent to the consideration not in money. So, money value of that part of consideration which is not in money has to be arrived at, and then that is to be added to the money value which is known upfront, and then on the gross amount GST is payable. If again due to some reasons the value is not determinable under A and B, what we have discussed, that is open market value is not available, money value of non money consideration part is also not ascertainable, not determinable, then in that case the draft law have proposed, rules have proposed that value of supply of goods or services of like kind and quality has to be taken. Again, this concept is also defined in the rules. We will discuss about that, what is open market value and what is like kind and like quality, value of like kind and like quality supply of goods and services. That those concepts will again discuss separately, but in a flow first we will understand here how to determine a value in this situation. So, and then even by following this A, B, C first 3 rules which we have discussed so far, sub rules, even a value cannot be determined by following these rules, then the value shall be the sum total of consideration in money as determined by application of rule 4 or rule 5 of this set of rules in that order. First we have to follow rule 4, that is not possible, then rule 5. We will see the provisions of 4 and 5 as well, but by following these 4 and 5 the value has to be arrived at. Now, first before going to this other sub rules 2, 3, 4, 5, first we will understand what is meant by open market value. So, open market value is more or less defined as a transaction value. What are those ingredients of open market value, or what is that meaning? Supply of goods or services. For supply of goods and services, open market value means the full value in money for supply, and then the taxes, GST taxes. Any other taxes we are not talking here, only taxes under GST, IGST, CGST, SGST, Union Territory GST, compensation says shall be excluded, it is not part. And then where the supplier and the recipient are not related and price is the sole consideration. So, in those parameters one has to arrive at what is open market value, and that open market value can be considered here. Now, we can take one or two examples to understand this concept. For example, where a new phone is supplied for 20,000 rupees along with exchange of an old phone, and if the price of new phone without exchange is 24,000, the open market value of the new phone is 24,000. So, since there is an exchange of old phone for a new phone, and then the new phone is sold or supplied for 20,000, it is not its open market value, because the similar same phone without exchange of old phone, if it is supplied or sold for 24,000, its open market value is 24,000, and in that situation we have to consider the value. Though our invoice will say 20,000 as a value, GST has to be paid on 24,000 and not on 20,000. So, again, one another example, if a laptop say is sold for 40,000 or supplied for 40,000 along with barter of a printer, and that manufactured by the recipient, and the value of printer known at the time of supply is 4,000 rupees, then the open market value of the laptop is 44,000. So, I am supplying a laptop for 40,000 against barter exchange of a printer which may be an old printer or which may be a new printer costing 4,000 rupees, then the open market value of the laptop is not 40,000, it is 44, because I am getting a printer against a laptop. So, which is a part consideration of printer, not in money. So, that either money value has to be arrived at, or if the open market value is already known, in a sequence I will first follow and consider the open market value, which is in this example 44,000, and GST is payable on the 44,000 accordingly. So, supply, again we have to understand one concept of supply of goods or services both of like kind and like quality. So, this is a third condition when open market value is not available and the consideration of which is not in money, if also not ascertainable in money terms, then how to arrive at the value of supply? In that case, the third sub rule, that is C, which takes care, which is saying or prescribes supply of goods or services or both of like kind and quality. So, there would be another supply, comparable supply available, comparable goods. In the earlier example, another similar laptop, another similar mobile handset. So, any other supply of goods or services under similar circumstances. What is that? Is not that just one laptop is of Lenovo is comparable with Asus. So, again there are certain parameters that in respect of the characteristics, quality, quantity, functional competence, material and the reputation of goods and services. So, that brand is also equally important. So, on these parameters, if some comparables are available, then that would be termed as like kind and like quality. So, is more or less it is a relative concept and likely to have different interpretations conveniently by the taxpayers in a different manner, by the taxing authorities in a different manner. So, it is more or less a abstract thing and will always have interpretation issues, and there may be a possibility that somebody who is following this provision likely to result in disputes at least at lower levels, and getting some clarity by clarification by authorities or by decisions of the court cases will take some more time, but otherwise one has to understand that we have to find out a comparable supply of goods and services, and this comparison we have to always make this comparison from the character, quality, quantity, functional competence, materials and reputation as well. And if such comparable goods are found, that value has to be taken here for the purpose of supply. So, now we will move to a sub rule 2. What is that? Value of supply between a related party or between a distinct person other than agent. So, related party, we have already seen the meaning, that how the persons are related while discussing during a transaction value under section 15. Now, a distinct person, the concept is those taxable suppliers who are required to obtain registration under section 25, 5 and 6, that is like a depot. Though my PAN is same, I am only one person, but since I have a fixed establishment in other states as well, and the law is treating me as a different person. So, in such situation, that is a stock transfer to depot. So, depot, warehouse in another state, so would become a distinct person, and then related person, the meaning we have already discussed, but here the agent, situation of agent is excluded. So, for this sub rule we are limitedly discussing about supply between distinct persons with same PAN and supply between related persons. What is the provision again? First we have to find out what is open market value. We have already discussed about what is open market value. Then if that is not possible, if that is not available, then in that situation the value of supply of goods and services we have to take from like kind and like quality. So, again we have to find out comparables, whether a comparable is available, then the value can be taken from that comparable. So, one is open market, not available, find out the comparable, take value from that. Still it is not possible, that is also not possible, then again in a sequence we have to follow rule 4 and 5, which we will see as well what is the provision 4 and 5. So, but here one important proviso is made, that is most important, because where the recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be the open market value, because there are possibilities of disputes that when I am transferring a stock from state A to state B, my valuation would get challenged by the tax authorities and unnecessary disputes will get created, because anyway I am going to get a IGST credit in a state B. Now, in such situation the proviso will be helpful, and where to avoid litigations the proviso will make it clear that so long as I am going to get a input tax credit being a distinct person in state B, whatever tax paid IGST, I would be eligible for credit. So, such type of things should not be challenged, but for some reason I am not eligible for the credit in a state B. In that situation obviously we have to follow the rules to find out the real value here as per the rules, that is open market value, comparable value, and then if that is not possible we have to follow provisions of rule 4 and 5 in a sequence. Then here in sub rule 2, principal agent transactions were not covered. So now rule 3 takes care about this situation. What is this situation, or what is the provision here? The open market value of goods being supplied or at the option of supplier, the value shall be 90% of the price charge for the supply of goods of like kind and quality by the recipient to his customer who is not related. So, is the option given to the supplier that he should adopt the value of supply of the recipient directly, and 90% of that value he can consider as value of supply at his end. Now, here most important thing I would like to point before you, when we were discussing about concept of supply of like kind and like quality, and again here the open market value, the most important thing, these concepts like kind and like quality, it is not defined only or always from the supplier points of view. So, is not that what is the supplier is supplying. The lawmaker, the plain reading of the definition or the concepts, it is clear that it is not from the supplier or even from any other supplier who is not party to this transaction, and he is supplying like kind or quality goods or services, that value also can be taken. So, an example would make it more clear. Say this example is given in the provision itself, draft law itself, when groundnuts are sold or supplied by principal to his agent, and then that agent is supplying similar groundnuts for, say for example, 5,000 rupees a quintal to independent customer. Now, at the same time, any other supplier who is not party to this particular transaction, but he is supplying groundnuts of the same quality, like quality or same quality to that agent, say for example 4,600 rupees. Then at the option of the supplier, supplier can choose 4,600 as the value of supply, or he may choose 5,000 rupees, which is the groundnuts sold by the recipient to the independent customer at 5,000 rupees. So, 90% of that is 4,500 rupees. So, against 4,500 and 4,600, at the option of the supplier, he can select any of the value. Here the question is ascertaining 90% of value of supply of the recipient to the unregistered to the independent customer is more easy, but from the market, what is the value at which any other person is supplying the goods or services, and what is that value? Really, to get such database to the supplier who has to pay the GST really is a very difficult task. So, many of the suppliers would be following prima facie this 90% route. Now, again, if the value is not determinable, what we have discussed above, be the value as determined by application of rule 4 and 5 in that order. So, we have discussed 3 sub rules. First 3 rules, first rule takes care when the value or consideration is not wholly in money. So, partly in money and partly not in money. Then a second situation when supply is to distinct person or related person, and the third rule when the supply is to or through the agent. So, what will be the value? So, we have discussed so far as 3 situations. Now, in all the 3 situations, there is a mention that rule 4 or 5 will sub rule 4 or 5 will be followed if whatever we have discussed so far is not possible to follow. So, let us see what is prescribed under sub rule 4, rule 4 and rule 5. So, rule 4 is value of supply of goods and services or both based on cost. So, where the value is not determinable under any of the rule we have discussed 1, 2 or 3, then it shall be the cost plus 10%. So, that is 110% of cost of production or manufacture or cost of acquisition of such goods or cost of provision of such services. So, 110% mathematically has to be arrived at, but here the real question is what is that 100? 110 is a mathematical answer, but to arrive at 100 what is a cost is always again interpretation issue, because really total concepts have changed. So, even for goods there are some cost accounting principles. Now, excise law till the date we are following CAS 4 to arrive at the cost of production, but now here again we have to understand cost of production, cost of manufacture, cost of acquisition, again different concepts are there. Which sort of accounting principle to ascertain the cost we have to follow, and then more important or more complicated thing is to understand, find out cost of provision of service. So, for goods still there are certain principles, for services it is more difficult. So, though on the face this provision appears similar, that we have to just take 110%, but the disputes or reading between the line or understanding what is the cost is real important issue. So, which needs to be more clarified, otherwise there would be another series of disputes. Now, if 4 is also not possible, then the rule 5 has to be followed. So, this is particularly all provisions we have to take into account, general provisions of section 15. So, is like a residual provision, best judgment or something like that, but that determination has to be done by the taxpayer itself. So, it is not talking about best judgment assessment by the authority. So, here all the general provisions of the valuation rules and basically the section 15 have to be considered, and then taking a view or getting a clue from all these set of rules and section 15, one has to arrive at legitimate valuation. So, again it is a interpretation part, and the only important thing, because just under rule 4 we discussed that ascertaining cost of service supply is really difficult one. So, and we have seen from rule 1 to follow 4 and 5. So, obviously 4 will come first, but still for service suppliers have given this option that they may directly jump from rule 3 to rule 5 instead of entering into rule 4. So, in case of supply of services, the supplier may opt for rule 5 and disregard rule 4 altogether. So, that is possible for the service suppliers. Now, we will see today also in service tax law certain valuation methods for service specific situations are taken into account. So, more or less similar situations are prescribed in the valuation rules for such cases. What are those cases? Purchase or sale of foreign currency. So, what will be the valuation? Difference in buying or selling rate and the Reserve Bank of India reference rate at the time when this exchange has happened, multiplied by total units of currency subject to certain conditions and cap. So, is a complicated provision given and different rates are there, different valuation concept is there, but there is one option given to this. One may not follow this, but follow this optional composition value. What is that optional composition value? If exchange of currency in INR and that exchange is up to INR 1 lakh rupees, in that case 1% of the gross currency exchanged subject to minimum value to be considered as 250 INR. There is no upper cap, maximum value as such, cap on the upper amount, but there should be minimum 250. Now a second situation here, scenario here, exchanging 1 lakh INR up to 10 lakh INR. So in such situation, the value shall be INR 1000 plus 0.5% of the currency exchanged. And if there is a exchange of INR exceeding 10 lakh, in that situation the value shall be INR 5000 plus 10% of gross currency exchange. Here there is no minimum cap, but there is a maximum cap that the value shall not go beyond 60,000 rupees. So this is for purchase or sale of currency. Now valuation rules relating to air ticket booking. So more or less this is rule 6.3, and currently also under service tax law, those who are providing services of air ticket booking, they are covered here. So what is option or what is the value rule given here? 5% of the basic fare in case of domestic booking and 10% of the basic fare in case of international booking of passage by travel by air, for travel by air. So this 5 and 10. So in a current regime, if we see today, it is 0.7 and 1.4. So more or less this is little beneficial provision if we think that 18% rate is applicable, but let us see the impact when actual law is passed. And here the basic fare on which we have to arrive at 5% or 10%, so that basic fare means part of the airfare on which commission is normally paid to the air travel agent by airlines. So, but if that is the case, here it appears that only those who are getting commission from airline, that is only covered. So if I am a booking agent, sub booking agent, I am not a ITA agent, not getting commission directly from airline, then what will be the value? Because more or less the words are used shall be deemed, value shall be deemed for booking of air. Now is it a compulsion or is it an option? That is not clear, because today almost there would be a possibility that airlines have, with the passage of time, they have reduced their commissions, and then many a times even the booking agents are not getting commission or getting very little commission, they are charging service charges for booking. So whether GST is payable purely on service charge or whether the plain wording, grammatical reading of the law which is there as of now, which is in the draft form, it appears that there is no option and this has to be followed. So that implication one has to understand here. So this is about air ticket booking service. Then life insurance business. What will happen with life insurance business? What sort of GST is applicable? The first thing, when the entire premium for life insurance policy is towards the risk cover, so there is no investment saving is linked in the premium, then it appears GST is not applicable at all. Actually speaking, these sub rules are not meant for giving exemptions, but one interpretation is following from the wording that so long as the premium is only for risk cover for the life insurance, then the value will be nil. and then if the value for life insurance policy where parameters have been prescribed to ascertain the values. So, what are those parameters? When the portion allocated for investment is communicated separately. In that case, gross premium less the investment portion will be the value. If it is a single premium policy and investment portion is not communicated separately, then in such situation the 10% of single premium would form the value. Then a third situation, it is not a single premium and the investment portion is also not published or not communicated, rather than we should say not communicated. In such situation, multiple premiums are there. In that case, value for GST would be 25% of the premium for the first year and 12.5% of the premium for each year in a subsequent year for each multiple premiums. So, this is for life insurance. Now, person dealing in buying and selling of second hand goods or used goods. So, this is always again issue. In that situation, what will be the value, because this would be more specifically applicable for a business of sale of second hand or used vehicles, two wheelers, four wheelers. Though this rule is applicable for all goods, is nothing to do specifically with automobile industry, but mainly sale of used goods. This is one of the predominant business where used cars, used two wheelers are being sold or supplied. What will be the value in such situation? The value of supply shall be the difference between the selling price and purchasing price subject to below conditions. What are the conditions? Dealing in goods as such or after such minor processing which does not change the nature of the goods. So, nature of the goods is intact, should be intact, and where no input tax credit has been availed on purchase of such goods. In such situation, the value for the GST purpose will be the selling price minus purchase price, and if such value of supply is negative, it shall be ignored. So, no GST would be applicable in that case if it is negative. So, this is for buying and selling of second hand goods. Then, in case of supply of token or vouchers or coupons or stamps, that is stamps other than postage stamps, which is or which are redeemable against supply of goods or services or both. In that case, rule 6, sub rule 6 takes care about this situation. Value shall be equal to the money value of the goods or services or both redeemable against such token, voucher, coupon or stamp. So, this is a case for vouchers. Then this rule 7, earlier in the earlier draft there was no discussion about pure agent transactions. So, anybody who is incurring expenditure purely as an agent of the principal and then recovering such expenditure at actual from the principal, whether GST would be applicable or otherwise. Here the rule 7 prescribes expenditures or cost incurred by supplier as a pure agent of the recipient of supply of service. This is applicable for supply of service cases only, shall be excluded from the value of supply. Here supplier makes payment to the third party for the service procured as the contract for supply is between third party and the recipient of supply, and provisions applicable if all the prescribed conditions are satisfied. So, almost there are set of 12 rules, 8 plus 4. If all conditions are satisfied, then only there is a possibility that such recoveries would qualify purely as an reimbursement by pure agent and would not attract GST. So, this is more or less similar provision of Rule 5.2 of Senvat credit of service tax valuation rules. So, I can give you one example that what type of transactions would get qualify here to rule under Rule 5.2 or now in the proposed Rule 7 of the GST valuation rules. For example, a custom house agent clearing goods for the providing service for clearing imported goods for an importer, and time being assume that 100 rupees he has paid for importation of goods in form of customs duty, and then recovered that 100 rupees along with his fees from the importer. Obviously, legally that customs duty is payable by the principal who is importer here or the service recipient here, and any such recovery by such custom house agent would not attract any GST because it would qualify those 8 plus 4 rules prescribed in a draft. So, this is regarding valuation rules which are at the draft stage, and then there is a possibility that they may get accepted or recommended in toto or some changes, and then during the meeting of GST Council in the second or third week of the May, that is 17-18 is happening, and it is likely to get this there would be a discussion on these rules, and finally final draft of the rule will get recommended to the parliament. So, Nikita, I would like to know as well that whether we have received some of queries, questions as such that we should answer.
Since valuation is a very deep topic, we have received quite a few questions. We'll take some of your questions now. So, sir, a person has asked, will branch or depot transfer be taxable under GST?
Yes.
Even if without a consideration?
Even if it is without a consideration that would attract. The first thing is supply. It will qualify as a supply. There is a schedule 1. So, under the definition of supply, certain transactions which are in the nature of supply without a consideration. Basically, supply for consideration is liable to tax, but there is a schedule 1 and which covers certain entries, and then all those entries, if the transaction is covered there, even such transaction is not for consideration, would attract GST, and such a branch transfer or depot transfer is covered there under schedule 1, and thereby we have to take help from the valuation rules to ascertain what is a transaction value, at what price one has to pay GST. So, obviously, a open market price which we have discussed so far, or like kind, like quality goods. So, notionally we have to arrive at the value and pay IGST, but paying that IGST, it would not be cost because the input tax credit of that IGST would be available in a state where depot is located. So, it is not a tax cascading as such, credit is admissible.
Okay. And are there any provisions for reverse charge under the current rules or act?
Yes, there is a provision of reverse charge under this law. Only those services or goods, today the reverse charge is prevailing in respect of services. Even there is a one example of reverse charge in case of central excise law as well for molasses, but otherwise in general there is no reverse charge for goods, but GST law has prescribed reverse charge mechanism even for goods as well. But today we don't know the list of goods under reverse charge and list of services under reverse charge, but only as of now the the bill, CGST bill, we can see two things. There is a certainty, particularly one is import of services, there would be reverse charge, and another situation, if a registered person getting supply from unregistered supplier, there would be again a reverse charge. tax has to be paid under reverse charge. And obviously by getting power, government would notify certain goods or services, for example GTA service, really don't know whether that would be again under reverse charge or otherwise, but possibility is more that government has power, and obviously they will come with some list by way of issuing notifications, and reverse charge will be prescribed in that situation as well, and all the valuation rules in that case have to be followed.
Okay. And so suppose there is a transaction of supply, so will free goods or any free material that is given against supply of goods, will that attract GST?
So free goods means, are we talking about a barter exchange or is really free? So for example, I will give two examples, so I think it would make it more clear. One situation that I am charitable organization and then I am distributing some medicines for the cost of charity as such. So it is a supply and I am not charging anything to whom I am supplying or distributing these medicines for a consumption as such. Could be one of the examples. So it is really free as such, because there is no consideration flowing in any form, neither in money form or not in any kind form as such. So ideally that transaction should not get taxed under GST, because it is not a supply of goods or services for a consideration. But another situation, I am providing certain advice being a professional, and in turn I am providing advice to a trader, and in turn the trader is giving me some of the goods in which he is trading. Say my advice is for 100 and he is giving me again some traded goods which he is doing trading, and the cost is 100, which is free of cost, then this will be considered as a consideration in kind, not in money, and the money value will have to be arrived at, and GST in that situation have to be paid.
Okay. And sir, what will be the treatment of discounts under GST, like business discount or commercial discount?
Yes, we have discussed on the discounts as well, so I will reply to this query, that discount per se in principle would be allowed as a deduction from the value of GST. So discounts may be either pre-discount, pre-supply or post-supply, so long as pre-supply discounts which are settled along with the transaction in the invoice itself, ideally there will not be any dispute, and section 15 sub rule 3 is taking care of this situation, and such pre-discounts are allowed as a deduction and no GST is payable on it. But the post supply discount, that I have charged full value, because today I don't know whether the recipient would be eligible for a discount or otherwise, and then after 2 months, 3 months of supply, thereafter if the discount is required to be passed by way of, say, by way of credit notes, then in principle such discount would also qualify as deduction, and both supplier and recipient should ideally get benefit of GST on that discount portion. But it is, we have to follow 3 conditions here. First is that scheme of discount should be known in advance at the time of supply, that is a precondition. Then each such discount which is given post supply has to be tracked with original invoice. And the third condition, that the recipient to whom this post supply discount is passed on has to reverse the proportionate attributable input tax credit from his books of account, and he has to do that compliance. So that 3 conditions have to be followed. So this situation may be like a turnover discount. Say condition may be, I will give you 5% additional discount if you sell 100 quantities in next 3 months. So obviously supplier would not know that next 3 months the recipient dealer is going to make sale of 100 quantities or otherwise. So one situation I will pass upfront discount assuming he will satisfy the condition, but as a marketing strategy, if that is not possible, the upfront discount will not be given, and after the 3 month condition will be situation will be discussed, and if those parameters are satisfied, after 3 months supplier will give a credit note allowing that additional 5% discount. But the conditions which we have discussed so far, these 3 conditions are satisfied, benefit of GST on the discount can be claimed.
And so should insurance charges be included in the calculation of assessable value?
Yes, so long as, because there is a concept of incidental expenses incurred and charged or recovered. So that is 15(2), sub rule 2 is taking care about this situation. All incidental expenses which are incurred by supplier and charged in the bill or invoice and recovered from the recipient, so all those incidental expenses, so insurance may be one of it. So loading, unloading, packing, insurance, inspection, so these are generally of incidental nature, because main transaction or composite supply is of that particular goods itself which are sold or supplied to the recipient. So these are incidental expenditures. So either my price will be one single price where all those elements are not known, or my price is say X or 100 and I will charge packing 10 rupees, insurance 10 rupees. So my price or value for GST will be 120 and I have to pay GST on 120.
Okay. And so one last question, that suppose there is a set of goods which is sold at X amount and the another set of same goods which is sold at X minus 10 rupees, that is at a concessional value. So is there any idea that which value will the authority accept?
See, we are in a transaction value regime basically. So when we are in a transaction value regime, per se there would not be any challenge. There can be multiple transaction values as per the multiple transactions. So is not that for say on day 1 to a customer I may sell a particular goods at 100, on day 2 or on the same day I may sell same goods say at 95 or 115 to customer B, to customer C. So being a transaction value regime, per se value cannot be authorities cannot reject the transaction value per se which is disclosed on the declared on the invoice. The only thing we have to consider here, whether the recipient is a related person or otherwise. If he is a related person, then only any discount or any reduction in the value will have to be considered separately, and we have to follow the valuation rule. Real has to be arrived at, and notionally that value has to be taken as a value of supply. Otherwise, so long as I am making sale to independent party who is not related to me, and then price is the sole consideration, nothing is coming in any form either in money or in kind to me as a additional consideration separately, so long as these conditions are satisfied, each and every transaction is independent, and I may have multiple transaction values for the same goods for different periods in the same year, there should not be any issue at all.
Okay. We thank sir for taking out his precious time and explaining us the concepts of supply and valuation, and hope we answered most it on the GST corner of the ICSI website in the coming week. Apply at the same time next Friday. Thank you.
Thank you.